Good evening, everyone. Welcome to the channel. Today I am going to talk about FI interim report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. FIH Mobile Limited offers a diverse range of businesses and services, including integrated manufacturing services for the handset industry, design and manufacture of handsets, trading and repair of handsets, development and sale of mobile/IoT devices, smart manufacturing services, intelligent automotive solutions, software engineering services, vertical solutions, research and development activities, import and export activities. The recent performance of FIH Group plc, LON, FIH and Fairfax India Holdings, TSX, FIHU has been modest at best. According to available data, both companies have seen a significant but not spectacular increase in their stock prices over the past year. FIH Group plc experienced a 15% gain for the full year and a 30% surge in the last 30 days as of September 17, 2025. Fairfax India Holdings saw its stock price rise by approximately 22.18% over the past 365 days and 21.5% in the past year. These figures fall short of the reported 119.34% increase, rendering it impossible to identify specific news events that may have contributed to such a surge. The primary drivers of revenue growth or decline can be categorized into several key areas. Revenue growth drivers: increased demand for electric vehicles and government support for the automotive electronics market, expansion into new product lines and markets, driven by advancements in case trends, connected, autonomous, shared and services, electric, strong exports from China. Fueled by government stimulus efforts, these factors have contributed to a significant increase in revenue. On the other hand, several drivers have led to a decline in revenue. Revenue decline drivers: weak handset demand and inflationary pressures, geopolitical uncertainties, tariff volatility, and shifts in customer outsourcing strategies, industry competition, and market saturation in the mobile phone market. These factors have negatively impacted revenue growth. Net income and profit margins: a shift in fortune. The financial performance of a company has undergone significant changes over time. Initially, net income increased from a loss of $31.6 million to a profit of $6.2 million, indicating a substantial improvement. However, this trend was short-lived, as net income decreased by $17.2 million due to various factors, such as lower interest expenses and share of loss from joint ventures. Despite these setbacks, the company's fortunes changed for the better. Net income increased by $6 million, followed by a significant jump from $11.5 million to $28.8 million, representing a 150% increase. This upward trend continued in 2024, with net income increasing by 98% compared to the previous year. Profit margins also experienced a notable improvement. The gross margin increased from 1.51% to 3.64%, while return on equity, ROE, improved from -2.1% to 0.4%. These gains can be attributed to sales growth and effective cost control measures implemented by the company. However, it is worth noting that profit margins may have been negatively impacted by restructuring charges and asset write-offs at the joint venture. The company's financial performance indicates a concerning trend. Despite its efforts, the business is currently experiencing negative operating cash flow. This means that it is not generating sufficient revenue to cover its operational expenses, resulting in a net outflow of cash from core activities. As such, the company is struggling to sustain itself financially and may require significant adjustments to improve its financial health. The company's debt level and interest expenses have undergone significant changes in recent years. In terms of debt level, the total current liabilities increased by 9% on page 7, but external borrowings decreased from $341 million to $130 million on page 60. This suggests that while some areas of debt may be increasing, others are being reduced through loan repayments. Regarding interest expenses, there is a clear trend of decrease across multiple pages. Interest expenses decreased by 57% from $30,318 to $13,136 on page 5, and similar decreases were observed on pages 11, 13, and 45. This indicates that the company has successfully reduced its interest expenses in recent years. The company's financial performance varied across different regions. The European market saw significant growth, with revenue increasing by over 112% and profit rising by nearly 100%. Similarly, the American market experienced a modest increase in revenue and a substantial rise in profit. On the other hand, the Asian market struggled, with revenue declining by approximately 20% and profit decreasing as well. Mainland China was particularly affected due to changes in VAT laws and compliance costs, leading to poor performance. Management is optimistic about the company's outlook, emphasizing several key strategies. The company aims to drive growth through investing in technology, partnerships, and innovation, with a focus on customer centricity and operational agility. Diversification and expansion are also key goals, with plans to explore new industries, such as robotics, and expand into new markets. The company is making strategic investments in emerging technologies like V2X and IoT, while strengthening its consumer electronics business in mainland China. Additionally, management is prioritizing sustainability and green energy initiatives, aiming to achieve 100% renewable electricity within the coming years. Financially, the company plans to optimize cash management, reducing bank loans and interest expenses through global engagement. Overall, management's strategy focuses on driving growth, diversification, and sustainability, positioning the company for long-term success. The company has made several strategic acquisitions and divestitures over the years. Key acquisitions include the Nokia-branded feature phone business from Microsoft Corporation for $350 million, HMD's convertible bonds for $38.3 million, a fourth capital injection to Fusion in May 2025. On the other hand, the company has also made significant divestitures, including discontinuation of low-margin businesses, termination of business with Hun Hai due to its own capacity planning, disposal of underutilized and unutilized assets, consumer electronics manufacturing business sold to Hun Hai. The company has demonstrated its commitment to returning value to shareholders through two key initiatives. Firstly, it has paid out dividends, with $8.1 million recognized for withholding tax on declared dividends in mainland China. Secondly, the company has also engaged in share buybacks, purchasing a total of 3,400,000 shares held as treasury shares. These actions indicate that the company is prioritizing shareholder value and rewarding investors through direct returns. Concerns about inventory buildup and supply chain disruption are prevalent throughout the financial summary. The U.S.-imposed tariffs pose external risks to the company's cost structure and supply chain, page 36. Market fluctuations can impact material costs and lead to supply delays, particularly with top suppliers accounting for 44.6% of total purchases, page 38. Geopolitical events have disrupted shipping routes and hindered raw material availability, while reciprocal tariffs are expected to raise production costs and restrict critical component flow, page 39. The potential imposition of U.S. tariffs and weak demand may also lead to supply chain disruption, page 45. Furthermore, inventory buildup is a concern due to the increase in inventory levels associated with expected shipment hikes in the third quarter, page 60. This has resulted in net cash used in operating activities of $375 million, primarily due to increased inventory levels. Overall, these concerns highlight the potential risks to the company's supply chain and operations. That concludes the financial summary for FI. Feel free to comment below, and I will be happy to answer them when possible.